Hello, and welcome to another episode of Trust Issues. Today, I'm sitting down with Richard Staveley, manager of Rockwood Strategic, to talk about the opportunities for investors in the UK small cap sector. Richard, many thanks for joining us today.
Thanks very much for having me on, Joe, and thank you so much for everybody that's bothering to listen in on what I have to say.
Excellent. We covered the trust investment strategy in detail on our last podcast, but for any new listeners, could you give us a 60-second elevator pitch on the trust?
Sure. In essence, we're targeting stocks on the London Stock Exchange, AIM, the main market, below 250 million market cap. We do that because that's where we think there's the least number of professional eyeballs looking at the stocks, so the biggest opportunities for mispricing and hidden gems are. We have a concentrated approach, so most small cap funds tend to spray, maybe a bit of praying as well, but we basically have 23 holdings, which we spend a lot of time both before in terms of due diligence in them because we have the time to do that, and then spending time afterwards in an engaged manner speaking to those companies regularly. So it's a concentrated approach. We have a genuine 3 to 5 year investment horizon. Unlike lots of investors, we're looking for stocks that can at least double in value, so 100% upside investment thesis point of entry. We have a value bias, and what that means is valuation really matters to us. You won't see ludicrously expensive companies built on future hopes. They've got assets and a lot of free cash flow, or the potential to generate a lot of free cash flow. That's what excites us about the businesses that we invest in. We have a not exclusive, but a genuinely large bias to recovery situations, primarily because the very few people that do bother looking below 250 million market cap tend to try and find growth, multi-bagger kind of emerging heroes of the future. We sometimes find those in recovery situations as well, but on the whole, we're looking for just decent companies that have fallen on hard times or been mismanaged. They have the potential for returning their businesses to profitability. And just finally, we are active. So we take stakes of at least 5%, so we can call EGMs if we absolutely have to, in most of our holdings. And we actively work with other stakeholders, being other shareholders, the board and the management, to try and catalyse the turnarounds that often the companies we invest in need to happen. I'm not sure it's just to finish, sorry, and then apologise, that's not 60 seconds. Unlike quite a lot of fund managers, we have real skin in the game, which isn't the strategy, but is a differentiating factor for us. I personally own about 1% of Rockwood, which is a very substantial amount of personal investment. And Christopher Mills, who started Harwood many years ago, owns about 23% of the fund. So we really do care about what happens with this fund.
Thank you for that. Moving on to performance in 2024, could you talk through the headline numbers and whether the key drivers were sector-driven, stock-specific, or M&A?
Well, really pleased in a year where most people was moaning for some reason or other about the UK stock market. We delivered 25.7% NAV growth. Really, really delighted with that. Just to calibrate that, we're targeting 15% a year over rolling 3 to 5 year time horizons. So that's a really good year for Rockwood. Don't plug that into a spreadsheet as what people should expect year in, year out. If we do 15% a year on average over 3 to 5 years, we'll be the number one small cap fund, for the number one UK fund of all time. If we meet our objectives, why not be ambitious though? We are
Absolutely.
actually the number one fund, so we were last year and we are now over the last 3 and 5 years. So really, really pleased about that. Unlike many people, I love not having to bang on about why I'm in particular sectors and why we're underweight or overweight and all that jazz. It really is a stock picking, bottom up style of investing. So sector weightings hasn't had any impact on the outcome. It's all been down to the individual stocks. And in that regard, we've had some absolute crackers, fantastic situations. And the first probably is the funding circle, which may come back to later on in the podcast, I suspect. But just to put it into perspective, that started 2024 at 40p a share, finished it at 134p a share. So we made a good 225% return in that during 2024. In Filtronic, another one of our largest holdings, that stock went from 21.3p to 76p during the year. So another 250% return. One of our largest holding, RM, which we think has considerable further upside, went from 65.2p to £1.5p, so that went up 61% during the year. Just remember, like UK was slightly positive, AIM was about neutral, so slightly down. So these are very, very significant returns relative to the market. And just finally, just because a lot of people thought it was a very boring thing for me to do, but we bought Galliford Try, the construction business has been recovering and turning around its profitability under Bill Hocking, and that share price went from 2.25p to £3.88 during 2024. So really pleased. Did you say M&A, Joe?
I did.
We actually thought we'd have a few more kind of outcomes during the year than we did. So it's slightly miffed that we didn't get some control premiums come in for holdings, but before it was a donut, so we managed in December to get a one bid for National World, which was a media business that we purchased actually earlier on in the year. So it really has not met our target of being invested in things for 3 to 5 years because it's being taken over. But I mean, the context of where we're looking, it owned a load of regional newspapers and online media assets, including things like the Yorkshire Post, which is a really strong regional newspaper. When we bought it, it was on a PE of 4 times, EV/EBITDA of under 2 times, with 10 million of cash, and no one seems to care. And unsurprisingly, a trade buyer came in at the end of the year saying we can exploit this undervaluation, has paid us a really lovely premium. We bought the shares at about 13.5p and the bid's at 23p. So we've made a huge return out of that too.
Thank you. Very impressive set of numbers. One of Rockwood's differentiating factors is your active private equity style approach to managing portfolio companies. So, can you share a couple of examples where you've had a successful engagement campaign with management in terms of the key changes you pushed for and the impact that they had?
Yeah, I get this question relatively regularly. Obviously, your listeners are going to expect me to choose the one that makes it look the best. But just to be clear, we do a lot of engagement that we can't really talk about, where people are changing, it's not fair on careers and all that stuff. So there is quite a lot of stuff that we're doing that we just don't choose to crow about. The American activist funds use it as a marketing tool and promote their funds on the basis of how noisy they've been and all the rest of it. We try and be a bit more culturally British about it, try and do things quietly behind the scenes in a constructive way. Sometimes it's hard work than it needs to be to get the result that everybody wants or in shareholders' interest, but more often than not, it's all relatively smooth. The example, though, I think I'll choose, and it's only fair because it's still in the portfolio, it's a big position, and it's definitely something where we impacted the returns for all shareholders. It was actually Funding Circle. So we came across the company back end of 23, actually started buying a little bit then, but most of the buying was done in early 2024. And this company, for those listeners that don't know, it's a technology platform essentially facilitating the lending of money to British small and medium-sized businesses. And we're not an ethical, moral fund, but it can't be anything better than that, of channeling money into small British businesses. No one else seems to want to do it. So Funding Circle matches up people that can't get access to that kind of lend, decent return over what you get on lots of other asset classes. And they manage the application process, and they act as an aggregator of all the small Mrs. Meakin's pie shops and, Rosie's flower shop and things that need an extra 30 grand, 50 grand, maybe 100 grand to do something with their business and care deeply about their business, not thinking they're going to create fusion power or anything like that, which typically ends up in you losing all your money. There's proper businesses that need proper money, but very upset that Captain Mannering from Dad's Army doesn't exist anymore on the high street, and local bank manager doesn't exist anymore. They're on a phone for like hours. And I point this out because I think that average application takes something like 5 minutes to do. They get an instant response on 76% of applications.
Right.
They spend a huge amount of money. They spend actually over 100 million quid because, as you might imagine, to do it well, you need to have a lot of tech and data. It's a huge amount of data to pull in it. And when the time they floated, I will get to the point of the engagement in a moment, Joe, but it's worthwhile
it's
for
all good
listeners to know the background, because it shows the UK stock market and why there's a role for Rockwood to do a really good job for shareholders. Because basically that pitch was told to the stock market in 2018 of our Goldman Sachs, who listed it, and the stock market placed a £1.8 billion valuation on that. Roll forward to late 2023, early 2024, and the business is capitalised at 125 million. Literally everyone's lost nearly all their money. And we're looking, as we explained at the start, for recovery situations and value situations. And it turns out they have over 200 million of cash, but the market's valuing the business at 125 million, and that they're not far off, but have gradually got closer to making some profit. So he's like, okay, well, let's have a look at this. Realised that actually there's a really good business there. There's actually a good management team, essentially, but there were some things that needed to change. And we engaged on a number of those. The first was they were sitting on all this cash, that they liked the idea of having far too much cash on the balance sheet. So we said we really need to start buying back shares. That's in shareholders' interest. And they've gone on to do now 2 sets of buybacks, significant amounts of money, shares they're buying back. And we expect them to do more because we think they're moving into generating quite a lot of cash, and we still think they've got excess capital. So we're still continuing to engage with them to continue to do more buybacks. The second thing was they hadn't really done any in anger kind of cost cutting. So the profit, will get there with the profit in the end from top line growth, and we can just keep burning, and that's all right. And really they needed to get the business quicker to profitability. Now, they've sold off, since we've purchased, their heavily loss-making US operations, and then they've also subsequently announced, which we're really pleased to see, a decent restructuring effort, which is taking out, I think, about 15 million of costs, and announced for the very first time that they're going into profit in the second half of 2024. And it's difficult for businesses that haven't really ever done any cost-cutting, that have been in growth mentality. That's a real mental stretch for the management team to have got their heads around doing that. So really pleased that they did that. The final piece has been change of CFO. There's also been some tidying up of the board. I think there were kind of 11 members on the board. May have got that wrong, but I think it's literally 11, which is too many. So all those things have been gradually addressed. And as a result, the market's gone, crikey, what's going on here? And the shares have done extremely well, as we said earlier. Should continue to do well, and they've got results soon. They've had a recent trading statement saying everything's going fine, but the business is targeting a strong top line growth rate and 15% margins, and that should throw out a lot of profit as they continue to grow, disrupting or replacing essentially the banks in the UK, where there's a huge demand for these kind of lends.
Thanks for a very interesting insight into the opportunity you identified at Funding Circle. Can you briefly outline the investment case for some of your other top holdings?
Sure. I am conscious of listeners' time, so I'll just give you the very quick elevator pitches on the top ones rather than selection.
Great.
The largest holding is a company called RM. It's in the education sphere. It has 3 divisions. It's over leveraged, far too much debt. We've engaged with it on a thesis for them to essentially break themselves up and sell off the various divisions. We think that process will end up creating huge amounts of shareholder value. We've already made a decent return from this business. It's had a full suite of changes. So we've got new CEO, new finance director. The CEO's then applied, new head of transformation, new head of people, new heads of the divisions. And there we should be really, really close to the very first divisional sale, which should, on our view, pay off nearly all, or depending on which division they choose to sell, we don't know which one they will do, but that should pay off all or more than all the debt in the business, leaving the business with a very strong balance sheet, which will mean the risk rating on the equity will collapse down, and the equity should be able to perform better. And within that, one of the divisions is absolutely fantastic. We think that's been ignored by the market because of the level of leverage in the other divisions, which is a business that does a marking of exams. They're the market leader. I'd go as far as to say they're the global leader. Last year, they signed a massive contract with International Baccalaureate to digitalise the whole of their exam suites globally. So if you win that, you probably are the best, I would say. But they obviously work with a range of other examining bodies, from Cambridge Assessment that do things like my daughter's A-levels, through to the ICAEW and the ACCA accounting exams. And they're the leading edge of this process, which is how exams are marked, and obviously the heritage is scanning and all that stuff, through to digitalization and digital marking. And that business is making over 20% profit margins and growing at well above GDP and has international growth prospects. And we think that business alone is worth at least £100 million. The whole market cap is not much more than that. So that's RM. Second stock, very exciting stock called Filtronic. I mentioned it earlier. It's done very well for us. We think it will continue to do very well. Filtronic do IT hardware. We bought it when it was capitalized at £25 million. We've made 5 times our money. So it's capitalized significantly more than that. And what's really been driving their turnaround has been that they've won massive contracts with SpaceX, with Elon Musk, for his Starlink satellite network. We actually think it's the only stock Elon Musk that we're aware of has bought personally or got exposure to in the UK,
Excellent.
which is quite fun. I will sound a bit self-satisfied here. Apologise to anyone worried about that, but I think Mr. Musk paid 34p and we paid 13p, so they're now 76p. So he's done very well. Basically, Filtronic are a bunch of extremely clever people who are creating novel solutions to how you beam huge amounts of internet and data to these satellites rather than through fiber or through the ground. And their products are going into the next wave, they're currently going into the ground stations. They still haven't actually won any contracts to go into the satellites. So although it's done really well, we actually think there's quite a lot more they can do with Starlink themselves. Plus, there are a number of other people that are fast followers or trying to copy Mr. Musk, not least the other famous bloke, Jeff, Mr. Bezos, who's got his own network he's trying to put up with his rocket, which is called Kuiper, and he's got to solve the same problems that Filtronic have solved for Mr. Musk. So that's very exciting. The third one is not exciting, it's boring. It makes and distributes nuts and bolts, or fasteners is a slightly more interesting word for it, but it's not really
Yes.
interesting in itself. It's called Trifast, this company. Harwood have bought 15% of the company. Nick Mills is on the board on behalf of Harwood. And that business basically distributes and manufactures these fasteners that go into everything from household goods to automotive platforms to just everything where you see that type of fastener. And obviously, it's one of those things, once you get into it, if you haven't watched it on the magazine of the week on Have I Got News for You, there's a whole world of fasteners out there for everybody to get into. And essentially, that business is making just over 5% profit margins, and I think it should make 10. They agree, and actually they're targeting to get the margins up to 10. If they do that, the profits should double as a proportion of the sales. We don't think the sales are going to fall. We think the sales will gradually start growing again. And when they've done that turnaround, the level of profitability they make should justify a much, much higher share price. Again, new management team, new CEO, new finance director, changes to the board, restructuring. They're starting to go into the delivery period going forward. The final one I'm going to touch on, again, I'm worried we're running out of time, is Vanquis Banking. It's a new stock that we bought in the second half of last year. It's the former Provident Financial, which was the doorstep lender, which they don't do anymore. And it lends money to people who are struggling financially but can't seem, because of their credit rating or past history, struggle to get personal finance. But obviously, there's a premium for that, but they're not payday lenders or like Wonga was and all that stuff. Their rates are higher, but they're not ludicrous like those guys were, creating a vicious cycle of debt. They're sensible lenders. They're regulated by the PRA, by the FCA. They are actually a regulated bank. As a result, they take in deposits, which you can get a nice interest rate on if you're looking for one, Joe. They've got about 2 billion of deposits, mainly from people that have got excess cash and they're just parking it in high rates. And then they use that money to lend at obviously at a much higher rate than they offer out in the savings. That's how a banking model essentially works. The business has got a heritage of poor investment in technology, overcosted, and then a new management team. We've got the previous head of the Bank of Ireland, the CEO. We've got an HSBC finance director in a proper team, and Sir Peter Estlins is the chair. And the guys are essentially ripping out loads of costs, putting in new, not bespoke, by the way, that's where it always goes wrong with the banks, but basically off-the-shelf IT systems to modernize the business, and that should in time lead to a massive recovery in profitability. They've been sort of attacked by an egregious claims management company and a couple of others who just fire in spoof letters saying, pay our person, which is causing them a lot of cost and really a real problem for them because they have a regulatory requirement to deal with every claim. 23% of the claims they're getting in are for people that have never even borrowed from them, and they still have to spend money, time, and effort going through the process. There are going to be some changes we expect this year in how that process works, which should materially change the economics for the claims management companies of firing in so many claims. Once that's cleared through, that will really help profitability as well as the other measures. So it's on 0.2 of book value. We think it can make a mid-teens return on tangible equity. So we think Vanquis Bank, if everything goes according to plan, is going to make us 4 to 5 times our money from here. It has risk, but that's a asymmetric reward return versus the downside case.
Thank you. As it happens, I do have a savings account with Vanquis, so I
Do
have heard of
you?
them.
Oh my
I do.
gosh.
There's a really good interest rate.
Yeah, fantastic.
There you
Oh,
go.
great. Well, I hope all you listeners will do that, or if you don't, buy some Rockwood and have some exposure to Vanquis through the fund.
Excellent. Given there's been a lot of rhetoric about the shrinking UK equity market, are you still finding attractive opportunities and how is your current investment pipeline looking?
Yes, it has been shrinking, much to the annoyance of particularly the stockbrokers. But let's face it, it's not good for the country either that we have a shrinking market for publicly listed companies. And I hope the government is going to announce some initiatives or at least try and do something to reverse that process. Some of it is cyclical. So I think when interest rates start to fall a bit more, we should get slightly better animal spirits. What is great about Rockwood, as I mentioned at the start, is we have a very concentrated portfolio. So it's definitely a problem for fund managers who have 100 stock portfolios if the number of holdings just gets smaller and smaller. I suspect that they're compromising on stuff as a result. We're 23, we've still got, huge pool to pick 1 or 2 or 3 things a year that we think are absolute crackers. There are over 600 stocks on AIM. There's at least another couple of hundred at the bottom end of the main market in our universe. And it's a bit like Britain's Got Talent, that wonderful show, which I'm
Yes.
sure we all love, in as much as there are quite a lot of deluded, talentless companies.
Presenters or contestants?
Yeah, contestants, definitely,
Okay.
who are never going to get fame or do anything special. But there are, as the show has shown, some absolute stars out there. I remind you, our hurdle is we want to make 100% return. So we're just looking for those ones that we think can do that over a 3 to 5 year period. To just put it in context, last year was the lowest level of IPOs since the Numis Index was created in 1987. And AIM itself has gone from nearly 1,700 stocks to under 700 stocks from peak to where we are now. And the FTSE Fledgling Index, ex investment trust, has actually only got 23 holdings in. It's not really an index anymore. Sorry, I should answer your question. So the pipeline's actually good. We've got quite a few companies where we've done an awful lot of work on that we're sort of monitoring for potentially either an event, which was where we would make our investment, or a slightly better point of timing to execute on that. And then there's some other live things that we're very close to doing. So we have found some absolute crackers to put into the portfolio, but we're not looking to add significantly many more names. As I mentioned earlier, National World will leave at the portfolio in Q1. We're looking to add a couple of holdings this year, probably at max. So one thing that is true, again, rather sadly for us as a country and an industry, is that there have been many, many months of outflows from UK equity. Rockwood has, I'm sure your listeners will know, been growing and raising money against the tide. But that does mean that quite a lot of small cap managers are forced sellers one way or another, or selling things that they don't really want to sell. And being the other side of that is quite a nice place to be for the medium term.
As you touched on earlier, we've seen a fair bit of negativity since the autumn budget. So, what are your thoughts on the potential impact on UK smaller companies?
Gosh, yeah, Rachel from accounts, she hasn't really got things going, has she? I mean, if what
No.
are the headlines? Let's read through them. So she reduced the incentivization to invest on AIM by halving the IHT allowance. She increased the taxes on capital gains tax, which means that the rewards from taking the risk to make a capital gain are reduced. She increased national insurance contributions on British companies. She obviously didn't do anything with corporation tax, but we should be looking at how we get down taxes on businesses not doing anything. And she didn't introduce a British ISA. So that's not really a list of head girl type, stuff. So That has led to a reduction in confidence, mainly from corporates. Consumer confidence has been slightly more benign, but it's feeding in, and overall negativity. So that's not very good, is it? I'm pretty sure they know they've got to start doing some stuff to try and reverse that. Hopefully, there's a number of initiatives. Everyone's calling for different things. What we'd love to see is ISAs for British stocks. We don't mind that some of them have business operations overseas. We think in aggregate it'll end up with being good for the stock market, good for Britain. So we think tax breaks should be focused on British stocks. We also think that probably the confidence issue and the general sogginess that the economy is in at the moment probably leads to a slightly larger level of interest rate cuts than is currently expected, which would probably be quite positive for markets as they start to hit as the year goes. If there's any other requirement that we think they should look carefully at, which we think that they are, is the AIM relief for stocks that are in people's pensions. And I think they are apparently looking at that, which would be positive. There's no doubt, though, that we do need some government nudging. You can't just rely on market forces because it's in a real state, as the stats showed that I talked about earlier.
Thank you for that. And one final question, if we may. As we head into 2025, what do you see as the key themes for the portfolio? And are there any areas of the market you're particularly excited by?
It's all about what happens with the individual stocks. I think from that perspective, the theme is essentially the catchword would be delivery in 2025. More than half of the portfolio have CEOs that have been in place now for 1 to 2 years. And in the first phase, when you change the CEO, obviously they can't have an impact straight away. They're deciding what to do and then enacting what to do. And you only really get the benefits on the bottom line as those actions come through. And it takes time. Lots of investors don't like this style of investing because they have to be patient about that coming through. We've been patient, we've built our positions, and now we think a range of our stocks are coming into a point where those CEOs have got to deliver the goods now. We've backed them to this point, but now it's delivery, and that delivery should then feed through to strong share price performances. So who am I talking about? Examples would be Flowtech Fluid Power, where Mike England went in, James Fisher, where Jean went in, Jean Vernet, Trifar, where Ian's gone in. There's new CEOs at STV, at Saatchi's. We have Nat Eddington, Filtronic, went into place last year and will continue to have a big impact on that business. So it's really delivery. What that will mean in the financials is margin improvement, and that's one of our kind of key value drivers in a lot of our investment theses. So we should see margin improvement in all the companies that I've just mentioned, and as part of the actions that these guys need to take to catalyze the share prices, we should see M&A type of activity. That would be more on the disposal front, so essentially selling off things to repair balance sheets or focus the businesses that they've taken on and get rid of non-core assets. I wouldn't be surprised if we have a higher hit rate for M&A than we had in 2024. In 2023, we had like about 5 bids in the portfolio. As I said, only one last year. Suspect there'll be more of that if the stock market remains kind of unloved as it is, as trade buyers and private equity buyers scoop up all these businesses and pay control premiums for them. Those would be the main things we're expecting in 25.
And on that note, many thanks to Richard for joining us today.
Thank you so much, Joe, and for everybody for listening in.
I'd encourage you to visit Rockwood's website, where, amongst other things, you can find Richard's latest investor presentations. You can also find our latest research note on Rockwood on the Kepler Trust Intelligence website. Thanks for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.